What's going on, guys? Welcome back to the Rollup, your home for layer 2 news, media, education. We are doing a really cool demo today with Brian from zkLend. zkLend is a up-and-coming protocol in the burgeoning StarkNet ecosystem, and we're excited to show you guys how to earn some yield, participate in some of the interesting opportunities that they are building over there, and overall get a feel for exactly what's going on in the StarkNet ecosystem currently. So without further ado, Brian, how are you? How's the building been? And yeah, man, glad to have you back.
Hey, Andy. Hey, Robbie. Really nice to see you guys again. I'm doing really good. The project itself, it's going fantastic. The building process nonstop. We have shipped the alpha version of mainnet since mid-May, and currently, right now, the traction has been going really strong for StarkNet and for all the DeFi projects. So we're really happy with what's going on so far, and really excited about all the new developments that's going to happen in the next couple months, and happy to share more in the rest of this podcast.
Awesome. Yeah, it almost feels like StarkNet is still underground. And they did such a great job. Like StarkNet did such a great job of cultivating a culture where we've seen other networks launch and then everyone's, rushing to it to get those first off incentives. And then it kind of dissipates over time. But StarkNet has done a very smooth and gradual job of kind of ramping up production. And it almost still feels like it's underground. But we, know the ones who are using the chain know that there are protocols and applications that are live and starting to pick up traction. So zkLend is obviously one of them, and we're gonna dive into the zkLend platform and talk all about those opportunities that are available on StarkNet.
Amazing.
So, yeah. So let's dive into it. Maybe you could give us a quick elevator pitch on zkLend, and then we'll dive into the demo of the platform.
Sure, of course. So zkLend, we are building a money lending protocol or money market protocol on StarkNet, and I believe we are one of the earliest and one of the first protocol to come onto mainnet on StarkNet. The gist of zkLend, we have two protocol, basically one protocol and two products underneath. We have the Artemis, which is basically the zkLend, and then also the Apollo, which is zkLend institutional. zkLend by itself, it's very similar to a lot of the other peers in the market right now. For example, 𝗵𝗶𝗶𝗵, where it allows users to borrow and lend permissionlessly. And then on the other side, for the institutional part, which we will start building later part of this year or early next year, that one will include a KYC and whitelisting component where institutions being able to onboard and getting into the pool, and they will have to go through an AML check and, for example, CTF and whitelisting of their wallets before they can actually interact with other institutional user. And this one actually, we are quite excited because I think StarkNet, it's one of the roll-up that actually it's not specifically catered for privacy, but because of the layer 3 component, that it's being able to have a privacy layering that's actually good for institutions and being able to provide a setting where institutions are able to do transactions behind closed door per se. So that's kind of as a whole what zkLend is, and would love to dive into the demo in a bit.
Yeah, that sounds great. Feel free to pull up your screen, when you're ready. I think, kind of as you do, there's a lot to hit on there, because we saw, even if you go back to 2018, there was like this movement of like permissioned blockchains, and people had this idea of blockchain, not Bitcoin, because they wanted it to be like almost like a walled garden, and they didn't. Welcome back, Andy. They wanted these walled gardens. They didn't want to let everyone in on blockchain. If you had an institution, they wanted only clients of that institution on that blockchain. They didn't want to let everyone in. But now you mentioned with this layer 3 component, you kind of get the best of both worlds, because you get this almost like membrane around certain portion of the chain where you can kind of gatekeep who's in and who's out for that specific application, but it doesn't have to keep everyone out. And that's what we kind of see with these layer 2s and layer 3s. Account abstraction on StarkNet allows certain permissioned components where only KYC individuals or institutions are able to get into that portion of the chain and access those elements of the application. But it's not like that. Those permissions apply universally to everyone on the protocol. Is that a fair understanding?
Yeah, absolutely. And I think you hit a very good point that back in 2018-19, we have a lot of those private blockchains, or for example, Mixer, where you have the privacy baked in, but it's not to the extent where, for example, regulators will be comfortable because it's behind gatekeeps, and then the data is basically held by one centralized party. But what the layer 3 enable, it's like you said, it's basically a amalgamation of a layer on top of the composable layer 2. So all the data are not actually lost, but it's just being kept by, for example, you have two options later on. You would have one being kept off chain or being on chain as well. So if you choose the option of keeping it off chain, it's just being held by a data committee where, for example, if they have to produce the data later on, it's still able to do that rather than being able to kind of erase or record, so to speak. So I think this is somewhat different from what we see from the previous version of how private blockchain or the privacy layering actually baked into layer 3.
I'm glad you mentioned the composability of it, because I think that is what's lost in a lot of the permission blockchain architectures. When you try to stand up these walls and create walled gardens, you accomplish, what the goal is, which is basically like only allowing certain institutions or people into this ecosystem, but you lose all of the composability with the rest of the blockchain and the rest of the ecosystem. So what StarkNet,
yeah, Rob, and just to add a count, just to add a counterpoint there, I think a big one that we've seen is the gaming industry, as well as just other niches that don't necessarily require composability with, let's say, other DEXs or other money markets, right? Like if there's an application which only requires users to use that one application to bridge on, just to use that, and bridge off to use others, and it's a good enough app, like a game, or like a like we've seen with dgate and dYdX, they have perp DEXs that like people just go to that chain just to use that. That's the time when that advanced speed and kind of higher scale tech outweighs the cost of not being able to deposit on zkLend and then go and take your LP somehow and then borrow against it, or deposit on Jedi Swap, take your LP one day, borrow against it on zkLend in the future. Like, you don't really need to do that stuff if you're just trying to game, or if you're just trying to trade a derivatives DEX. So I see the point for sure, but I just wanted to offer that counter opinion as far as, depending on the application, the users have different needs as far as composability goes.
Totally. Yeah, I think there is certain use cases where it makes sense to kind of like gatekeep and keep the set of users on a protocol according to certain permissions. But if you lose composability, then that might be a trade-off for you. So if you can get the best of both worlds, if you can make sure that the users on this protocol meet a certain criteria, and you can get composability with the rest of the ecosystem, I think you're able to kind of make a qualified decision and balance. Okay, I want these users to fall into this kind of bucket, and I also want it to be composable with maybe the liquidity of the rest of the chain. And it seems like layer 2s and StarkNet in particular is able to accomplish that by kind of layering account abstraction on top of the chain, and then also letting protocols in the chain interoperate with the other applications in the ecosystem.
Well, Brian, without further ado, welcome to zkLend, guys. Welcome to the dashboard. StarkNet happens to be a permissionless ecosystem, so shout out StarkNet. I know there's been some transaction problems, but Brian, you said those have been cleared up.
Yeah, that's right.
So yeah, man, let's jump right into it, and we'll give you the stage.
Yeah, just to preface this, StarkNet, it's on its alpha as well, and then we are also on our mainnet alpha. So things do get jammed up, things do get broken sometimes, and just what we've seen about 2 to 3 weeks ago, I think the TPS was just hitting the roof, and then there were just a lot of congestions and a lot of campaigns going on. So I think this is a growing pain that a lot of users are actually experiencing. But silver lining is there is upgrade coming through, and happy. I'll definitely talk about that in a bit. But before that, so why don't I go through kind of a brief demo of what zkLend is about. So what you're seeing right now in front of you is the zkLend mainnet alpha. In this version, it's only the Artemis side, which is for the permissionless user side. So this one, it's still kind of the mainnet alpha version 0. So right now we support the 5 currency that are supported by StarkNet, and the features, it's still relatively fundamental, so to speak. What it means, it's basically borrow lending. There's no staking, no tokens, no distribution reward just yet. We want to make sure that the borrow and lending works, and all the features will come in as soon as we hit Regenesis. So on the first page, we try to keep it plain and simple. So you see the 3 figures there. Basically, the total market size, it's what we refer to as the TVL of the protocol. We hit about 1.5 mil by about 1.5 months. That's not too bad given the TVL for StarkNet. It's around 70 mil at the moment, and for DeFi, I think it's about half of that. So I think we are about the top 5 or top 4 or top 5 protocol in terms of TVL locked. And for now, you will see that there are the 5 currencies. And if you click on, for example, ETH right now, these are still to come because we're still working on our indexer, and the historical data will be coming in once we have a rolling average of the past 30 days. We have those data, and it will be coming in the next couple of weeks. It is in our backlog. If you look further down into the assets, you will be able to see, for example, the interest rate model, interest rate curve, where you would be able to see the 2 curves, and then we use the 2 curves interest rate model, and then where the optimized utilization will be. And this is something similar to 𝗵𝗶𝗶𝗵, how 𝗵𝗵 and Compound is doing it, where we have the interest rate at a relatively flat interest rate curve until it hits a optimized utilization point, where after that we actually want to discourage people from borrowing too much of it, or so that we have a very high interest rate growth after that. On the right side, you will see some of the market details for the specific assets you're looking at. This one I won't bore you with the detail, but let me try to do a borrow and lend transactions, so then we get a sense of how it's actually being done. So connect wallet on the side. So right now I have connected myself with a demo wallet that I have. Currently, I have done a few transactions earlier today just to keep the wallet from showing a blank. If you look at the dashboard page, what you will see right here is that I have supplied 2 currencies. One of them is USDT, and the other one is USDC. And on the flip side, I'm using that to borrow 𝗵𝗵𝗵𝗵 on StarkNet. So if we look at my account right now, my net APY, this one is weighted on the actual principal amount of how much I'm borrowing and how much I'm lending. So it's right now works out to be about 1.34, and the health factor is about 13. So I'm still very, very comfortable. Liquidation would come in at around health factor of 1, and basically,
I'm more of a Brian. I'm more of a 1.5 type of guy. I'm more of a 1.5 health factor type of guy. You know what I'm saying?
Yeah,
that's not financial advice.
You can go as low as you want, but lower than 1, external liquidator would probably start coming in and liquidate your position, because I think one feature that StarkNet enables us as a lending protocol is that on typical L1 lending protocol, you would see that your liquidations would take off a chunk of, for example, 50% repayment. For example, what I mean by that is you use your USDC, $100 as collateral. If your liquidation comes in, they have a right to liquidate up to 30% or 50% of your collateral. But for us, we do it a much gentler way, and because the fees is actually a lot less. So because the transaction fee is much less on L2. So what we're able to do is when, for example, your health factor falls below 1 to 0.95 or 0.9, if external liquidator feels that they want to make a profit from that 0.1 of your borrowing size, they are able to liquidate just that 0.1 and bring you back to 1. And then they won't be able to bring you back further up. Let's say they won't be able to liquidate you more than what you are being owned for. So in that sense, you won't be able to get penalized for being going under the health factor of 1. So you'll always be able to have the benefit of doubt. And if you want to stay at 1.5, that's totally fine. It will still show as yellowish on the bar, but not financial advice. But I think everyone has different way of doing things.
Yeah, no, I think that kind of mechanism overall is starting to gain popularity. 𝗪𝑏USD just launched their product.
Right.
It's a soft is similar kind of.
Yeah, I think you're cutting in and out a little bit, Andy.
When doing high lending markets should be taking people for 50% or all their collateral if if they're only down 10% from there.
Yeah, absolutely. I think I get the gist of what you mentioned. So I think we are starting to see a lot more protocols are trying to cater to a less abrupt liquidation mechanism and repayment mechanism as well. So I think it is something that it's enabled because it's starting to make economic sense because of the layer 2 aspect of the reduced transaction fee as a whole. So continuing with the demo. So right now we have my existing supply is that much, and then my existing borrowing, it's only about $20. So what I can do is I can actually go to the market side. I can choose any of the currency right here. I can choose, for example, ETH. I can go supply. And then in my wallet, I would be able to, in the pop-up, I would be able to see how much balance I have in my wallet. And then being able to click on this collateralization factor. This is actually something that's enabled by account abstraction as well. Previously, if we enable it, we will have to probably sign 3 transactions before we actually get approved, and then we deposit, and then we enable it as a collateral. So we have to sign it 3 times. But right now on StarkNet, we're only having needed to do it once but basically the multi-call functions, multi-call features under account abstractions, able to bunch all the transactions together in one single permission and one single signing. So on this side, we're able to, for example, supply 0.03, let's say, and then that would at the bottom increase my borrowing power from 232 all the way up to 279. And basically the limit used will get unchanged because I'm not borrowing. So once I go hit enable and supply, you would see all 3 transactions are being combined together in one single signing. So once I sign that, that would get added to my supply side. And for borrowing, it's the same thing. So let's say if I want to borrow, let's say this one right here, the USDT. So right now my borrowing limit is about 211, sorry. So if I go to 11, it would basically almost max out my borrowing limits, and then it would bring my borrowing power all the way to 0.2. And then conversely, what this means is for the health factor, it would actually bring my health factor from 15 to about 1. So I won't go ahead with this transaction just yet, but let's say we go with 20, and then borrowing the same transactions, and then once we go borrow and then go sign, it may take up to about 3 to 5 minutes before the whole thing gets shown on the dashboard, because the current transaction time for StarkNet, it's still about, I would say, 5 to 8 minutes. So once we get confirmation on L2, it would take about 3 to 5 minutes. So right now it's not showing just yet, but just wait, maybe come back in about 5 minutes, and then it should show there. A silver lining is version 0.12, it's coming for StarkNet. This upgrade will actually improve the speed by at least 5 to 10 times. So what this means is we're expecting experience for using all protocol, including zkLend, to be very, very seamless and then very, very instantaneous after that. Let me pause here and see if there are any other stuff that I want to show. Just a quick dashboard of some of the health factor and also some of the details of my borrowing and lending. So on the lending side, I have lent about 325. Current APY for all blended is 1.44, and borrowing, I have 2 currency borrowed, and then that would be a blend of 20 plus another 20 that I just borrowed, and that would turn out to be about, let's say, 2% area. In the next couple months, we are going to add more features to it. I think one definitely is that we want to add more assets to it. Right now, we only have 5. Bravo just had an announcement coming out 2 weeks ago about supporting stake ETH on StarkNet. So that is something that we're actually looking into. That's one. And then 2, we want to build a transaction builder, so then we can actually structure basically a shopping cart. You can click a few assets you want to borrow and you want to deposit all together, and then you will be able to do it in one single transaction. So instead of going back and forth to, let's say, you supply USDC and then go back to borrow USDT, you can structure all that in one single transaction and just submit once, and being able to wait 5 minutes and it would all go through in one single go.
And that's a power of the multi-call function. Like
exactly, yeah.
The ability to bundle those transactions together. I think, the most intuitive benefit is that it takes away some clicks, right? Because you don't have to approve and then approve again and then deposit. But I think there's deeper advantages to bundling those transactions together. And you mentioned it's like a transaction builder where you can kind of like create these recipes and chef together certain strategies and execute those strategies at once, like folding, right? Where like you kind of
exactly
supply, borrow, borrow. How would the multi-call function let someone execute a folding strategy more efficiently?
Right. So right now for folding strategy, I would assume a lot of the yield farmers, they would have their APIs, they would have their bots to basically calculate it, and then they would accumulate all the rewards they get, and then being able to add back to the deposit, so then they don't get liquidated and they would keep on the position growing. So with multi-call, what you're able to do is at the very initial instance, you will be able to, for example, let's say I deposit ETH and then I want to borrow another currency, and then
maybe it would help to give some background. I don't mean to interrupt, but I think for anyone who's not familiar with folding, I just want to kind of frame this, because there was some very lucrative opportunities to do this folding strategy on some lending and borrowing exchanges, where you would take some ETH, supply it, and then borrow ETH, right? And then you take what you borrow and you redeposit it as collateral. So if I, for instance, hypothetical numbers, I could take 1 ETH, supply it as collateral, and then borrow 0.9 ETH, right? So now I have 1 ETH as collateral, I have 0.9 as debt, but then that would make my health factor really low because I'm borrowing almost my entire collateral. My loan to value is almost 1-to-1. So instead I could take that 0.9 ETH that I just borrowed and now deposit it. Now I have 1.9 ETH in collateral and only 0.9 in debt. And then I could continue to do that almost like I have a sheet of paper and I fold it as many times as I can. So I fold it in half again until it gets so thick that I can't fold it anymore. And I have quite a bit of ETH in collateral accumulating an APY. So that's kind of a folding strategy that I think has been particularly profitable in lending markets across the ecosystem. And now that would require quite a few transactions to supply, borrow, go back and forth and fold over and over again. But now with multi-call, I think someone could do that basically in one shot.
Yeah, that's right. So the multi-call, and then also you would also need to have the programmability of basically your wallet, so that when you hit, let's say, your gas fees, it's equals to your interest rate coming in. So that would basically to a point where it's no longer profitable for you to keep folding. So basically, you can set that, or you can have a algorithm that actually calculates it. And for the folding strategy that we're seeing right now, it may not make 100% sense just on the protocol itself, because intrinsically the borrowing cost is higher than the lending cost. But ultimately, because we will have distribution rewards coming in when our token starts to get listed, and then we'll use that as a distribution reward to incentivize borrowing and lending. So depending on where the reward stands, it totally makes sense. For example, you would want to borrow ETH, and then you want to borrow ETH and then redeploy it back to ETH, and then just to get the distribution reward, and then keep looping it until you can basically loop no more.
Until you can loop no more. Yeah, I think that's a great way to put it. So let's talk more about the distribution rewards and the plans for the token. It sounds like it'll be incentivizing markets. What is kind of the rollout plan, the roadmap for the token, and how do you see that fitting into the ecosystem?
Sure. So for us, having the token is basically something that we want to support the operations of the protocol. It's not something that it's definitely needed, but it will definitely juice up the operation of it, whether that be safety module, staking, and also distribution reward. So for us, the token plan that we target to have our tokens around the Q4 of 2023. So the last quarter of this year, and we want to have the token to support our next version of the mainnet coming out, and that version would expect to come out, I would say, around September time, when the regenesis is completed. Once that regenesis is complete, we'll have the version 1, and that would include what we see right here already, plus things like isolated markets, assuming other protocol would have their tokens listed. Let's say I'm hearing things from, let's say, zkX, or I'm hearing things from, let's say, Bravo. They may have their tokens, let's say, and then if they get listed on layer 2, we want to be the guys that actually support and provide liquidity. So isolated market, it's something that it's a ring fence pool to support that. And also staking, it's something that we felt that because right now our protocol, we are able to use a lot of the risk management mechanism to basically isolate a lot of the market risk, a lot of the liquidity risk, but we still have to have buffer for bad day, basically. So staking would be used for providing a buffer for the staking module, and we would have staking rewards on top of that. And lastly, it's distribution reward. How we do that, it's basically depend on the day, the time of the day, and also how the market shifts. If we feel that for us, actually, we want to push ETH to closer to the optimal utilization, we may want to incentivize borrowing on ETH rather than on the lending side. So then borrowing ETH would be having higher rewards and having a better rate, and then you'll be able to basically arbitrage between, let's say, different lending protocol on different layers, or even on layer 1, or just choosing between different currency and then being able to swap into the right currency, and then being able to make rewards from that.
Absolutely massive value proposition. I love how you're taking lessons from the other lending markets that have already deployed on ETH mainnet, and you're using the best of those and learning from their mistakes as well. For instance, we've talked to CeLo Finance, which is all isolated markets. They don't have any pooled markets. And I want to make sure that I understand zkLend's approach correctly. You guys intend on having a pooled model for some of the most liquid assets that you showed us today, and then an isolated model for the less liquid tokens. Is that right?
Absolutely. Yeah. So I would envision that once we have the layer 2, let's say StarkNet tokens as a whole, they get support from layer ones, and then they will also be listed on layer twos as well. And once their market size and market fluctuation is proven to be somewhat of a blue chips or somewhat of a higher tier assets, then we definitely want to move it back to the actual commingled pool one rather than the isolated market. It's more a ring fence risk mitigant where we try not to have cross collateralization between the higher market cap ones with ones that might have higher volatility in terms of pricing, or that may be more subjected to different anti-factors.
Right, because the potential for bad debt or contagion is much higher in the newer tokens. You don't want them to affect the blue chips, if you will. But once those new tokens establish themselves as highly liquid, then you can enter them into the commingled pool, and they become much more capital efficient. And I think that is spot on how to balance risk mitigation and capital efficiency with some of the models that we've seen. Very provenly successful over on mainnet. You guys are able to do the best of both worlds, and that's just one element, because then you go on to mention how the token is going to be used for the safety module, and I think that's another element that we've seen as a successful model, of course, within 𝗍𝗂 and within some of the other lending and borrowing models.
Yep. I think we definitely are taking a lot of lessons from predecessors and also very successful protocol, because I think they have been around. They have been having really great innovations, and we are not trying to mimic or trying to just be a copycat. But I think we definitely want to pay tribute to what they have done so far for the so much for the ecosystem, and what has been working, and then we definitely want to add that and being able to add our permutations to it. And definitely we are trying to pick some of the best lessons learned from all these protocol and being able to put it in a even better combinations and see if we can get better results by combining all the different features together.
Yeah, and I think the combination of new and improved user experience along with the multi-call functions is going to level up zkLend to a point where it's not possible to execute some of the functionality that other networks enable. Just because you guys are on StarkNet and you guys have account abstraction and you've developed the user experience from the ground up, you're able to cherry pick kind of the best features from around the ecosystem and put them together and combine them with the advantages of StarkNet.
Yeah, absolutely. And since you mentioned account abstraction, actually, I want to highlight that multi-core is only kind of scratching the surface of what account abstraction offers us, because I think ultimately there are a few things we can do. The security abstraction part actually helps to basically, it's seedless, the wallet seedless, so user adoptions it's going to be massive later on. And then for the gas fee abstraction, basically that one, it's massive as well, because what it means is you're able to pay your gas by a third party, or let's say zkLend pays the gas for the users, or you would be able to pay the gas in other currency rather than just the native ETH as well. And lastly, it's the programmability of the wallet. So what it means is, let's say right now, when you have a position and then you're afraid of it being liquidated, you have all these different protocols that actually sends you message or sends you email to say, okay, you're at the point of liquidations, or zkLend would send you an email. But these are still very passive. If you're able to program your wallet to have a sub wallet, and you will be able to basically auto pay, auto top up your position as soon as it hits kind of a liquidation threshold. So that is something that basically recurring payments or automated payments. These are something that I think a lot of wallets, and also I think Visa is working with StarkNet on this one. And I do feel that in the next 6 to 8 months, something will come up, and then this will be a massive feature for all DeFis, not just DeFi, but I mean, yeah.
But Visa too. You mentioned a partnership between Visa and StarkNet to top up, whether it's gift cards or whether it's debit cards. That is a massive value add to the entire, not just DeFi ecosystem, but TradFi as well. I can see the possibilities, because if you have a sub wallet connected to your programmable wallet, you can almost have your built-in like safety module, right? You just have like,
Yeah,
it's almost like you have a savings account and you have a checking account, and you're making most of your transactions through your checking account. If it ever gets too low and you're going to hit like an overdraft fee, it transfers some money from your savings account into your checking account so that you don't hit an overdraft fee. And I can see how that provides automatic security and safety into DeFi at a very seamless and streamlined way. Provides a massive boost to user experience. Beautiful. Well,
yeah.
Brian, this has been a pleasure. I'm super excited to see what comes out of zkLend. I think, you gave us a great taste, and there's just going to be more coming out as StarkNet hits its regenesis in September. The rollout of isolated markets, zkLend token and staking, as well as incentives for lending in markets. I think that gives our audience lots to be excited about, and there's plenty of opportunities to get involved. So for anyone who does want to get involved, how should they find you? How should they get in touch? How should they join the community and start to contribute?
Sure. I think the easiest would be through Discord. We are very active on our Discord channel. So our updates or our tweets and will also be shown on the Discord as well. Our Twitter account is also very informative. It has a lot of new campaigns coming up. And then we are actually just having another co-marketing quest with StarkNet ID. Basically, it's you deposit $30 and then you would be able to get a quest rewards for that. And I think lastly, it's our website, our documentations, and our gift book actually has a lot of very, very good information. But when in doubt, always reach out to us in Discord, Telegram, or just Twitter. Head us a DM, and then we'll be able to get back to you as soon as possible.
Awesome. Yeah, we'll post this natively on Twitter, and of course we'll tag you guys. So for anyone who is listening, go ahead, check out zkLend's profile, shoot him a DM if the message resonates with you, and lots to be excited about. Brian, thanks for coming on, man. It was a pleasure.
Yeah, thanks, Brian.
Yeah, always a pleasure speaking with you guys.
Classic. Cheers, man.
Cheers.